inflationary situation and rising interest rates has SMSF investors revisiting their portfolio allocations to suit these variables. Mark Pay from Rush Gold is with me today to explore this issue. Welcome, Mark.
Thank you very much, Darren. I'm very happy to be on your show.
Let's start with the current economic conditions. What could the trend to higher interest rates and higher inflation mean for SMSF investors?
I don't think it's a secret that the secular kind of macroeconomic background looks to me that we've moved to a more of an inflationary environment. We had the Reserve Bank the other day say that they expect inflation to rise as high as 7% and maybe higher. In that kind of environment, obviously it's very challenging for the share market. We also looked like we're going to get higher interest rates, which is challenging for the bond market and for property markets. Investing is always a forward-looking exercise. Yeah. It's as though we're driving a car and we're peeking in the rear view mirror, but we really need to look at what's ahead of us on the road.
Yes.
So if we do get to inflation of 7% or more, I think people are going to be much more focused on capital preservation. We've been in a long period, secular bull markets, where growth was really what everybody was thinking about. And this has been a reminder. I think the NASDAQ is down something like 20% so far this year. But this has been a reminder that there are two parts to a cycle. Not everything always goes straight up. Now, the concern on our side looking forward is that even though the Reserve Bank has said we're headed for 7% inflation, they're still adding petrol to the fire. So we have a big new, stimulus program out of the US. We have New South Wales saying that they have tripled their budget spending. So on the one hand, we have an acknowledgement that this is an inflationary environment coming, but we don't really see the policies yet that acknowledge that and try to actually do something about it. Now, those policies are not very fun. It's austerity, it's reduced spending, it's tightening our belts. I don't think anybody really wants to, hear that message and wants to really, play by that book. So that would be our concern going forward.
Yeah, they may not want to hear that message, but I'm sure they are necessary policies to take forward. So given the current investment market conditions, why should SMSF trustees consider an allocation to gold?
Yeah. So, as I mentioned before, I think it is a capital preservation asset. Now, we have been conditioned in a very low interest rate environment, low inflation environment, that preserving capital is not that interesting. It's not that important. It's not that sexy. We seem to be moving to a very different environment to where the loss of purchasing power becomes the number one concern for an investor. If you have a nominal return of 5% on a company or on shares, but the rate of inflation is 7%, then you're going backwards. And so investors now go backwards just by sitting in cash. So I was at Woolies the other day. I bought an avocado, I got a chicken, and I had a loaf of bread, and it was $29. So just sitting in cash, I don't think it's an environment people are used to, where staying in one spot is not really staying in one spot. And so really the biggest investors in the world, whether it's central banks, whether it's ultra high net worth, certainly the big retirement plans, the big pension plans, almost all of them have an allocation to physical gold bullion in one form or another. And they do that because we do from time to time get into environments like we're in right now. Again, it's a forward-looking exercise. We can look back at the past 12 years of central bank stimulated bull markets, and that's fantastic. And there were fantastic gains that were made in shares and bonds. But really, is that forward-looking exercise is what happens from here. And that's why the precious metals, are always a part of the biggest investor portfolios. Yeah.
Yeah, just looking at gold investors, what's a typical profile of a gold investor?
Yeah, it's an interesting question. So in our company, we have investors from age 18 to age 98. Now the 98-year-old, presumably has got great plans for his kids and his grandkids and things like this. Look, I'd say it is across the sector. So small retail absolutely participates. I'd say certainly the funds community participates, the big end of town, the family offices. You look at gold as one of the most widely traded assets in the world. It trades almost as much as the S&P 500 every day. So that's all of the shares in the S&P 500 index every day. And gold trades as much as that, almost as much as that every day. So that implies a huge depth of market liquidity, huge investor interest. Now, some of these investors are the people who know the most about money in the whole world, and that is the central banks of the world. And so they trade tens and tens of thousands of tons of gold between themselves. So it's been an asset that is relied upon by many for many centuries by all types of investors.
Yeah. So gold's a slightly different asset. It's not like shares or property. What are the different ways that an individual can invest in gold?
There are quite a few different ways, but I'd say there are very important distinctions between them. So it's possible to buy an ETF, for example. Now that would be a fund that trades with normal market opening hours that may or may not convey the right to gold, but it does capture the gold price for you. There are the futures market. You can buy coins. You can buy outright metal. So in the case of an ETF, a fund, the investor should be aware that it's not really the form of gold ownership that has survived for thousands of years. Yeah. So you own a share. You don't necessarily own the physical metal. Now, this is only important when everything, falls over. And it does fall over from time to time. We've had things like the GFC, we had bankruptcies, things like this. You don't want to be at the end of the day owning a form of gold that you thought was going to protect you in the worst case scenarios, only to be left, without that protection exactly when you need it the most. So an example is in the GFC, we had a company called MF Global that fell over, big funds manager, commodities manager. They had a gold fund and the investor got paid out at 70 cents on the dollar. So, that's not really the kind of outcome we think people should expect.
Yeah. And if SMSF investors are looking to include a portfolio allocation to gold in their fund, is there any sort of guidance you would recommend as to how much gold they should include?
There's been some good academic work that's done in this regard. Oxford Economics, I would cite, and what they found is for a regular investor with, let's call it a 60-40 portfolio, so 60% equities, 40% bonds or property or things like this, that an allocation of up to 10%, maybe 15% of gold bullion can actually increase the return while reducing the price volatility of the portfolio. So it's a win on both sides. You get a little bit more return and you get a little bit less volatility. Now, I'd say looking forward, we can think about that, in this new economic environment we're heading into, and it makes even more sense than that. So that's a general rule of thumb. We obviously don't give specific investment advice without knowing more about your specific situation. But certainly, when we see, the big family offices and whatnot, that's the order of magnitude that they tell us they're thinking about.
Right. Now, there's been a lot of discussion about cryptocurrency and some people looking at that as an inflationary hedge, and that's maybe affected attitudes and the way that gold has reacted to the markets right now. How is that situation right now? Is it returning to what we would consider normal in these circumstances?
Yeah, it's a really interesting question. So gold tends to anticipate inflation. So we saw 2018, 2019, some 20 and 21 that we had good returns on gold. Now that there's been inflation has sort of arrived, that gold has been pretty flat this year. I think, the number through mid-year here in Australia, I think it's returned 5%. I think the 12-month return is something like 11% in Australian dollars. Now, but I would say that that's gold doing its job for you. If we've got, as I mentioned, the Woolworths index, if your purchasing power is dropping by 4 or 5 or 8% and gold is returning 12% in the 12-month basis, then it's absolutely doing its job for you. Yeah.
Well, that's very interesting. Thanks very much for your time this afternoon, Mark, and for sharing those invaluable insights with us.
Thank you very much, Darren. I appreciate it.